Hello everyone, wishing you and your family a happy new year and welcome to my channel. Today I will be conducting the second session on financial spreading, focusing on the creation of the profit or loss account, or we can also call it the income statement. So now income statement, several key terms are commonly used, including sales or revenue. We can also call it the turnover, then COGS or the cost of goods sold, then operating income, operating expenses, non-recurring items, that is non-operating expenses, non-operating income, then the depreciation, amortization, operating profit, EBIT and EBITDA, the tax, interest expenses, net profit before tax, payment of dividends, and net profit attributable to the equity shareholder. So these are the common term which are present in the income statement. So basically income statement prepared for the 1 year performance of the company, that during the 1 year how company has performed in terms of their operation, how they are able to generate operating profit, and also how they have also arrived at the net profit or net loss. So this is 1 year financial result preparation in a statement which is known as the income expenses statement, where all sorts of income and all sorts of expenses are recorded and adjusted, and accordingly the balance is known as either profit or loss. Now sales, the first sales or revenue or turnover is typically consist of both cash sales and credit sales. So for most of the companies, the majority of sales are conducted on credit, and with a smaller portion that comes from your cash sales. Now, the cost of goods sold includes all direct expenses involved in converting the raw material into the final products or the finished goods. This encompasses costs such as the purchase of raw materials, storage, the godown rental, the carrying cost of all the raw materials I have purchased and shifted to my godown, then the use of plant and machinery, which is resulting in depreciation because we are utilizing our machinery and the plant, and other related expenses which are directly involved in the production and giving the final shape of the final product from the raw material is cost of goods sold. Now, operating income, it includes revenue generated from the company's core operation, and sometimes company can also provide services. So sometimes we call that goods and services. So selling of goods will come to the revenue and sales, and selling of services, it will come under operating income. So any service income received by the company, any government subsidies received, then management fees received or commission income received, those are directly related to the principal activity or core operation of the company, will come under the operating income. And the operating expenses, that covers costs related to the company's principal activity, such as selling and marketing expenses. It means that the goods we have manufactured, now we are going to sell those goods and services to the market, for which we have to incur a cost which is pertaining to the selling and marketing expenses. Then the research and development cost, we want to further enhance our quality, then paying salaries and wages and other administrative expenses, which are indirectly related to the production of the goods. Now, in the next slide, this way we basically calculate the gross profit. Is suppose this is the hypothetical number, sales at turnover is 5,000, then direct expenses or cost of goods sold is 2,500. The difference is known as gross profit, and it is calculating by dividing by deducting the cost of goods sold from revenue, adding operating income to gross profit, and subtracting operating expenses results in the operating profit, which is very essential to calculate correctly. And I will conduct the second session, or in the subsequent session I will explain you what is the importance of operating profit, how EBIT and EBITDA is calculated, and how operating profit is contributing to the meticulous credit decisioning or credit risk management, and based on operating profit how EBIT and EBITDA is calculated, which is used as an important risk driver. And for the credit modeling, for single factor analysis or multi-factor analysis, this EBIT and EBITDA plays a major role. Okay. Now, depreciation is basically, I'm just giving an overall view, is depreciation that when we are using our tangible assets like property, plant, and equipment, machinery, which can be touched, which is tangible in nature, and the wear and tear or reduction of the value of asset is known as depreciation. Amortization, again, reduction in the value of intangible assets. Intangible asset like patent, copyright, goodwill, trademark, which has value, but it is invisible, like we cannot touch, it is intangible in nature. Okay. Operating profit, I have told you that how to calculate. Now, the interest expenses, it refers to the cost of borrowed funds on which the company is liable to pay interest. Company has borrowed money and for which company is liable to pay interest. And in contrast, the interest income is the revenue or income earned from the company's deposit or other liquid asset. Say for an example, like we have huge amount of cash deposited in our account or marketable securities or any other liquid assets for which we are gaining interest income. The income that is known as interest income. And similarly, the loan which we have taken for which we are paying the interest, or we are on a monthly basis or on a yearly basis, we are paying expenses, that is, or incurring cost, that is known as interest expenses. Now, the non-recurring items is basically the non-operational or non-recurring expenses or income are costs or income that are one-off or one-time in nature and not related to the company's principal activity or core operation. Example include like employee termination or severance cost, restructuring cost. Company can restructure its employee structure or company its management. Okay, then acquisition cost or merger cost. A company is going to acquire another company or going to merge with another company. This is not a regular activity in nature, and this is nowhere related to the company's principal activity. This is just for the company's expansion. So that sort of expenses, if it is included under operating expenses, we should not consider that as an operating expenses. Rather, it should be non-recurring in nature. Okay, sometimes also we have seen that company is going to close one of its business unit. So business closure cost, any derivative gain and income if the company is not into the financial sector. So first and foremost, every annual report, being a spreader or spreading analyst, it is their responsibility to read correctly that what is the core operation, what are the nature of the product the company is manufacturing, and on that basis they would take a decision. Okay, so now these are the cost. Decision means like if they that those costs will be termed as operating or non-operating. So these are not related to the core operation and should be treated as non-recurring. Okay. Now net profit before tax. Now after adjusting all the for the non-recurring items, the result is the net profit before tax. Like here is the example of operating income, service income, commission income, government. If I sum up all these three is 1500. Then operating expenses, example like salary and wages, advertisement cost, depreciation, amortization, bad debt expenses, the expenses which are yet to be received. Okay, or company is expecting will be bad debt. Now, selling and general cost, other indirect operational expenses, these all sum up to 2000. Now, the difference is negative 500. Now, 2500 minus 500 comes to the 2000. Okay, this is my operating profit. Now we are gaining interest is 600 and paying interest as 1600. The difference is net interest expenses or income is 1000. Again, as a negative because interest expenses is expenses, which is the type and flow is negative. Then non-operational income and non-operational expenses, those two adjusted and 1800. Now 2000 minus 1000 plus 1800 because this is income. Now that comes to my profit before tax, which is 2800. Okay. Once income tax, here it is 800, is deducted, the remaining figure is the net profit after tax. Note that net income and net profit are often used interchangeably to describe the company's and the net profit or net income and to describe the same concept. Okay. So finally, after deducting the minority interest, there is one more adjustment made that the minority stakeholder who has less than 50% stake the company. So company is also is responsible to share their percentage of profit, and once suppose it is 500, then the net profit is attributable to the equity shareholder is 2000 minus 500 is minority stakeholder is 1500. Okay, that's it. So now EBIT and EBITDA I will conduct the next session where I will explain you. So these are the very common term, and this is the standard format of preparing the profit or loss account or income statement for the corporate entities, and these are the items comes into the picture to calculate the net profit or net loss. For credit decisioning, when a borrower shares their annual report, the first thing would be checked is that the profit or loss account, if the company has earned good amount of operating profit or net profit or not, because all these expenses income contributes a major role for fine tune the credit decisioning. In the next session, I will discuss the significance of operating profit, provide you example and explain the expectation of every bank and financial institution in the financial spreading process. So once all the adjustments are made, the final figure represents the net profit before tax, and after taxation, the net profit after tax. That's it. We'll join you in the next session. Thank you.